Okay, let's talk depreciation. We first looked at depreciation when we did our adjusting entries, but we said, just wait on the numbers. We'll talk about that later. So now it's later. We need to figure out how we get the actual depreciation figure. To do that, we get to choose a depreciation method. There are several that we can consider. There's something called straight line depreciation. There's something called units of production, or sometimes units of activity method. There is declining balance, sometimes referred to as double declining balance. There is something called MACRS, makers or mackers, depending on who you're talking to. So there are several different methods that we can choose from and can use. So we're going to look at each one of those and how they work. Now, let me go ahead and mention actually the one that I said last, and I'll write it up here. MACRS, mackers or makers, stands for Modified Accelerated Cost Recovery System. This is one that you're required to use for tax purposes, but you don't necessarily have to use it for your financial purposes or your books. So while you will see this one for taxes, for your financial statements you can do something different. You can do both the same, but you don't have to. So this one, we're not really going to delve into how we calculate it, but just know that this is for tax purposes. Okay? So let's start looking at the individual ones. Let's start with straight line. Straight line depreciation is used most frequently. The large, an extremely large majority of overall businesses use straight line depreciation. It's probably the easiest one to calculate as well, so that's always a plus. It's easy, it's not too difficult. Most people use it, so we're going to focus the most on straight line, but we're also going to look through and I'm going to show you the other two types of depreciation as well. But we're going to spend the most time here. So let's look at a few items that I need to know for depreciation. The first thing I need to know is, what is our cost? The asset cost that we're looking at. So let's assume that we're dealing with a piece of equipment, and that equipment had a cost of, let's say, $80,000. Let's say that we had a useful life of the equipment of 10 years. And let's also say that we had a residual or salvage value, same thing. I'll put both of them up here. Maybe I will. Try that again. Equal to $2,000. Now let's talk about these items for a minute. Cost. Again, this is what is the historic cost of the equipment. This could have been purchase price plus the sales tax or whatever. We've talked about cost already in this chapter, and we should be familiar with what we would include in this. But it cost us $80,000. The useful life doesn't necessarily mean that at the end of 10 years that we're going to throw it away or it won't be worth anything. But this is just the useful life estimate of the equipment, especially for depreciation purposes. And that's the time frame we're going to look at, taking the cost of this asset and turning it into an expense for the company. Useful lives are based on several things. There'll be industry standards for this. You'll have tax guides that you can use, again, to help determine what the depreciable useful life should be. There are several factors that go into that. We're not going to have you try to set the useful life. We're going to give you that for these examples. But useful life we need to know as well. And then this third component, residual or salvage value. This is our estimate of the value or the cost that we want to leave over at the end of the useful life. So if we take your cost, the $80,000, and subtract any residual that you might have, now if you don't have any, then you would be subtracting zero, so the cost would be the same. That gives me obviously $78,000. But this is also something that we term. We call that depreciable value. And that means that I can only depreciate a maximum of $78,000. You're not going to depreciate $80,000 because I've set a residual or a salvage value at $2,000, so I can't go below that point. We have to stop there. So we can depreciate up to $78,000 total dollars. Okay? So for straight line, what happens with straight line is we divide this depreciable cost or depreciable value over the useful life of the asset. And each year, as long as you have a full year, you're going to depreciate the same amount each year. So it would look, oh, sorry, I'm just going to mark all over the place tonight or today. We would take, for straight line, I'm just going to, sorry, you take cost minus any salvage or residual value that you have, and you divide it by the useful life. And that's how you determine your depreciation. Also, cost minus salvage is the same thing as depreciable value. Okay, so we already know what that is, but I'm just going to rewrite it out with our numbers. That was $80,000 minus the $2,000 divided by, what was our useful life? Do you remember? 10 years. So if we do this math, you should find that you get $7,800 per year. So when we do this calculation, that is an annual amount. So that means that as long as I've had this for 12 months, then that's going to be the amount of depreciation that I'll put in my adjusting entry. But what if we haven't had it for 12 months? Let me give you both scenarios. So let's say this was a piece of equipment. We have a fiscal year of January 1 to December 31, and we bought this equipment on January the 1st. It's now December the 31st, and we need to make our adjusting entry up for depreciation. So it would look like this. We have depreciation expense. We're increasing it, so we're going to debit it for that $7,800. And then we would credit accumulated depreciation for equipment. We would increase it or credit it for $7,800. That would be our journal entry. But if, for instance, let's say that we purchased this on May the 1st, still the same fiscal year, January 1 to December 31. But now I have not owned the equipment for 12 months. I can't depreciate $7,800 because when we come up with that calculation, that's a per year figure. So now my entry looks the same as far as my accounts go. We still have depreciation expense. We still have accumulated depreciation for equipment. But that $7,800 was for 12 months. I only need it for, let's see, May 1st. So that's May, June, July, August, September, November, December. That's 8 months. So I need that for 8/12. So that comes up to $5,200. That's the amount that I'm going to take this year because it was a partial year. I didn't own that equipment all 12 months. I can't take the full $7,800. So in that case, we have $5,200 as the amount of the adjusting entry. Another way that you can do things, let me just get a new page here. You could actually calculate what we refer to as the straight line rate. And the straight line rate, you take 100% and you divide it by the useful life. So in our example, we would have taken 100% divided by 10 because that was our years. And this gives me 10%. So this is the straight line rate. I can take 10% and multiply it by that depreciable cost and get depreciation that way. So again, if we take the $80,000, subtract any salvage, that gives me the $78,000 depreciable cost. I can take that $78,000, multiply it by my depreciation rate or straight line rate, and get the annual depreciation figure again. Again, with partial years, you'd have to adjust that for the pro rata portion. But you can also use a straight line rate to get this. You're still going to get the same information or the same numbers. Now let's say that you were using straight line method, but something changed. Sometimes you revise your estimates because this is just an estimate. So let's say that originally you assumed you were going to have a 10-year life. Let's say that it's been 3 years. You've been depreciating this, and let's say it was 3 full years. So this was where we had the equipment purchased on January 1st of the year. So it's been 3 years. But now we've decided that going forward, we only expect to have a remaining useful life at this point in time of 5 years. So, what happens there is, all right, originally we're talking 10 years. Well, go forward 3 years. It's been 3 years already. How many years are left now? We should have 7 years left. But what I'm saying is, we want to revise that to having only 5 years left. Okay? Well, if we're only going to have 5 years left, I can't depreciate as much as I had. So, with our example, our annual depreciation was that $7,800 per year. And it's been 3 years. So after 3 years, I've depreciated a total of $23,400. Now each year, that $7,800 that went into depreciation expense is going to be closed or cleared out. But the accumulated depreciation is not. So accumulated depreciation should equal $23,400 right now. And again, at this point in time, according to my original numbers, I would have 7 years left to depreciate this asset. Well, what if I now decide that I only should have 5 years left? I can't continue depreciating $7,800 because that was based on the original 10 years. And again, that would be with 7 years left. I'm only assuming I'm going to have 5 years left. So what we need to do is we need to figure out a new depreciation rate per year. So to do that, again, I need to figure out what's my depreciable cost. Well, my original cost was the $80,000, but I've already depreciated $23,400 of that away. So the $80,000 minus the $23,400, right now that means we have a book value of $56,600. Book value is cost minus accumulated depreciation. So my cost is $80,000. My accumulated depreciation is $23,400. So my book value is $56,600. Okay, so now I can take that $56,600, subtract any residual that we have, which was our $2,000, and divide by the remaining useful life, the 5 years. So from here on out, I'm going to depreciate $10,920 per year for those remaining 5 years. Okay, enough of the straight line for now. Let's flip to a new page and do a different type of depreciation. Let's do units of production, or you'll see this referred to as units of activity as well. It's very similar to straight line. So you still start out and try to find the you get the depreciable cost first. So you start out with cost, you subtract any salvage or residual value. But instead of dividing by useful life, you're not going to divide by years, you're going to divide by the useful life in terms of the activity itself. So I'm just going to put, let's put total activity down here as a simplified way of putting that. Or total production, either one. So this would be like our same scenario that we just ran through. We bought equipment, cost of $80,000, residual value of $2,000, but now it has either a useful life of 10 years or 200,000 machine hours. Either one. So now we can use that to determine units of production or units of activity. So cost, again, $80,000. Residual, $2,000. So that again is our $78,000 depreciable cost. But now I'm going to divide by the 200,000 hours, not the 10 years. So this is going to give me a rate to apply when we need to determine depreciation. This should come to 39 cents per hour. So now each month or each year or whatever our period of time is, all I need to do is figure out how many hours we used that equipment and multiply it by this rate. So let's say for our first period, and maybe for the first year, we go calculate up and we used 24,000 hours. That's how long we used the equipment for. So what would my depreciation entry look like now? You still got depreciation expense. And you still got accumulated depreciation for equipment. How do we figure out the number? Well, we know we had 24,000 hours. We're going to multiply that by the 39 cents per hour. So that means that we're going to depreciate a total of $9,360 for this period, or this year, 6 year. So that is the amount of our depreciation entry. And that's units of production, units of activity. It's very simple, very easy. It's very similar to the straight line, but again, instead of using a useful life, you're going to use the hours. And you don't really have to worry about prorating for partial years because you literally look at the production or activity level. If you only use it for 2 months, then how many hours did you use it in those 2 months? You multiply that by the rate that we calculated.